Gassim Holding, an investment holding from Buraydah in the date country of Gassim, listed as 6020. In 2025, operating revenue was 9.3 million riyals. Net income was 4.2 million, earned almost entirely by the cash in the portfolio, not the operations. Zero debt, 101 million in cash, and a mandate to set. The plan puts the cash box to work. This is the complete CFO and business report. 3 signals stand out. First, the portfolio pays the bills. Interest and investment income covered the operating loss twice over. Second, the stub keeps shrinking. A 5th straight slide to 9.3 million. Third, nothing is owed and much is owned. Zero debt and 101 million riyals of cash. The plan runs 6 actions on one road. Publish the mandate and the NAV. Relet the Gassim farm assets. Ladder the treasury for yield. Hurdle rates on every position. A smaller head office. And a stated payout policy. Sequenced from 2026 to 2030. Each action has a gate before the next. The SWOT is honest, because it must be. The strengths: zero debt, deep cash, and a large investment book. The weak points: a shrinking stub and no published net asset value. The opportunities: relet farms, treasury ladders, and a stated policy. The threats: cash drag, concentration in unlisted positions, and governance drift. Michael Porter's 5 forces drawn on an investment holding. This company competes for assets, not customers. Capital is abundant here, so supplier power is low, but every family office chases the same deals and index funds offer passive yield to anyone. The moat is discipline, hurdle rates, published value, and patience. The model has 3 parts: a stub, a book, and a mandate to set. The farm and land legacy gets relet into the Gassim date economy. The cash earns on Murabaha ladders, and the portfolio compounds under hurdle rates. The stub must stop leaking. The book must be seen. That is the whole design. 4 pillars carry the plan. The people pillar, a small investment team with independent valuation support. The technology pillar, a portfolio and NAV system, and treasury ladders managed properly. The infrastructure pillar, farms surveyed, titled, and relet. And the digital core, quarterly value publication position by position. Every risk carries a probability, an impact, and a named owner. Cash drag leads the register, owned by the investment committee. Unlisted concentration is owned by the audit committee, with independent marks. The leaking stub is owned by asset management. Relet it or exit it. That is deliberate. Governance keeps the plan honest. The board sets risk appetite and watches the register. The audit and risk committee owns controls and capex stage gates. Management delivers a monthly KPI pack, a quarterly board review, and annual plan refresh. The context is a heartland region with real momentum. Buraydah hosts the world's largest date festival, and Vision 2030 is funding Gassim agri-processing and tourism. Meanwhile, cash fatally earns a real yield. The context rewards deployment. It punishes idleness. That is the whole macro story for a holding. The portfolio, drawn plainly: listed equities on the Saudi market, subsidiaries and associates, real estate and leasing, Murabaha and deposits, 101 million earning, dividend and interest income, the Gassim farms, ready to relet, the agri legacy, and the date economy around it all. That is what the holding holds. Peer comparison at live market caps. Now the twin cap contrasts. An holding carries an almost identical market value. It pays 11 million riyals of interest a year on its debt. Gassim collects 5 million on its cash. Mirror image balance sheets, same price tag. The lesson writes itself. Valuation, with every assumption on screen. Risk-free, 4.45. Saudi equity premium, 5.01. Adjusted beta, 0.51. The WACC lands at 7%. The plan discounts to 6.6 riyals per share. The market says 12.56. That values the operating stub and the cash. The investment book adds roughly 8.5 riyals per share at book value. Read the grid, not one number. No buy, sell, or hold verdict, ever. 5 catalysts to watch. The mandate and net asset value published in 2026. Farm assets relet through 2027. Operating break-even in 2028. The yield book compounding by 2029. And by 2030, a working holding with published value and a stated policy. 1 grid, 10 years. Actuals in green, plan in blue. Revenue climbs from 11 million to a planned 23 million reals. Earnings per share builds towards 0.19. No dividend is modeled until operating break-even, then the policy is stated. Labeled illustrative on every panel. 5 years in one picture. Revenue drifted from 11 million to 9, while the cash pile grew from 19 to 101. That is the whole story. A park balance sheet compounding quietly, waiting for a mandate. The share trades near 1.2 times book. Deployment decides the re-rating. 2 pictures explain the year. The bridge shows 8 million reals of gross profit absorbed by 11 of overheads. Then interest and investment income add almost 10, and the year ends at 4.2 million of profit. The cash picture shows the stub leaking 7 million. The portfolio funds it without borrowing a single real. The transformation map is a road from cash box to working holding. 2026, the mandate and the NAV go out. 2027, the farms are relet. 2028, operating break-even. 2029, the yield book compounds. 2030, a working holding. Published, earning, and disciplined. 9 numbers hold the budget up. Growth of 12 to 30% a year. Gross margin walking from 85 to 78%. Capital spending at 5% of revenue, easing to 3. Zakat and tax near 2%, and a payout near 0%. The balanced scorecard makes it accountable. Operating break-even by 2028, owned by the Chief Financial Officer. Treasury yield up of 5 million a year, owned by Treasury. 80% of farm assets relet by 2027, owned by Asset Management. Every target has a cadence and a name. The 5-year plan, in numbers, revenue builds from 12 million to 23 million reals. EBITDA recovers to 30%. Earnings per share reaches 0.19. No dividend is modeled, policy stated at break-even. All of it labeled illustrative, not guidance. The master budget allocates 2027, month by month. The date season leads this budget. August and September carry the harvest and the Bureta festival. Ramadan lifts the spring window. The leases recognize evenly underneath. A quiet budget, by design. 12 months, weighted the way the date season sets. 3 final charts close the budget. The harvest quarter carries the phasing. Of every 100 halalas of budget, cost of goods takes 17, and EBITDA keeps 10. Firm cash compounds to 9 million reals across the plan. The complete Gassim holding report is live at cfoinb.com. That is cfoinb.